We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is economist and wealth manager Jonathan Davis. How are you today, Jonathan?
I'm very good, Tom. It's lovely to see you again.
Great to have you back on the show. So you have written in a previous Booms and Busts report that we are soon moving from 2 generations of deflation to a generation at least of inflation. Markets are now beginning to react to this huge multi-decade change. So why don't we start by getting your explanation of how you see this inflationary change and what it means to you going forward?
Well, let's go to the first part of that briefly. I've been saying to new and old clients for many years now that, of course, we saw the peak multi-generationally in inflation in the 1970s, and we've seen inflation falling for decades, 2 generations. And it's very much like the pudding bowl, that we will see this, and then the last 10 years or so, or particularly the last 5 years, up till 2020, we saw neither inflation nor deflation. So we saw a basing in inflation and deflation, or disinflation. And of course, we've seen a sharp rise in inflation in the last 6-9 months globally. And I believe we're now not just soon to enter, but we have already started an era, not a period, an era of higher and higher inflation. And people talk about commodities are soaring, that's why we have inflation. I think it's the other way around. I think we have inflation, thus commodities are soaring and will do. And I think it largely comes from, as the guy said, inflation is always and everywhere a monetary phenomenon. The growth in broad money globally is double digits per annum. It's the rise in money is as fast as we've seen in decades in peacetime, if not in ever. Double digits per annum, free money. And I cannot see that ending because, I'm on the other side of the Atlantic, but everyone talks about the Fed. I even talk about the Fed. So let's talk about the Fed, because it is, after all, the most important central bank on the planet. The Fed is, of course, producing $1.5 trillion per annum. And indeed, the Treasury is helping that as well. And the Fed is achieving its objectives beautifully. Those who argue that the Fed's objective is stable money is, of course, arrant nonsense. Those who say their objective is low inflation is arrant nonsense. They're just looking in the wrong places. They're not looking at asset prices. They're only looking at the official inflation statistics, which, as someone said recently, if you take out the things that are growing, then of course you get no inflation. And yet, even with fraudulent methodology for calculating inflation, just going back to my side of the pond again, if we had the methodology of calculating inflation that we had in Margaret Thatcher's time in the 1980s, today we'd have circa 10% per annum inflation. Your listeners can look at Shadowstats, which shows that very clearly. Even in America, it's 5.7, I think it is, percent inflation. So even with fraudulent methodology, we've got over 5% inflation. And with the money printing, in order to achieve the Fed's objectives, which is to raise asset prices, because after all, the Fed doesn't work for you or me. The Fed works for its owners. The people who own the Fed are, of course, the commercial banks. It is still astonishing to me that people who are in markets don't know that basic fact. The Fed is achieving its objectives elegantly. Do not fight the Fed. I said that to you in this podcast just over a year ago. Mm-hmm. Don't fight the Fed. It's not something to be laughed at. It's to be something to be appreciated for what it is. So whenever the stock market, whatever you might mean by that, falls 10%, the Fed dives in. And the Fed will continue to do that for as long as its owners and masters determine it's appropriate. And when will that be? It's when the retail punters are all in. And that's when they will be shafted, of course. But this isn't going to just be about the stock market. The governments of the world require inflation. That is, in effect, the way they are going to treat the debts that they have, the politicians have created in order to buy our votes for decades. There's no way they're going to do an Argentinian-style default of just basically not pay it and become a financial pariah. That's not going to happen. They're not going to do a Greek default and say, yes, we'll pay the debts in 100 years' time. They are certainly not going to, what's the word, just cancel all the debts. That's not going to happen. They are going to go for the other default scenario, which is exactly what they're doing. Inflation. It's not future. I said future. They're doing it right now because they know they're at the end game and they have to get debt to GDP down. And the only way they can do that over 5, 10, 15 years is simply by raising inflation. Whether there's economic growth or not, in due course, the ratio of debt to GDP will fall, and then they can do it all over again. They're politicians. They don't work for us, they work for themselves. That's why we're going to have inflation for many, many years.
It's interesting the way that you bring that up. I know in Canada here, our Prime Minister Justin Trudeau said the other day that to in effect forgive him because he doesn't think about monetary policy whatsoever. Yeah. So
I saw that, and for the first time in his political life, he was honest. Yes, we should listen to what these evil people are actually telling us. And in fact, I've got something, I don't know if I printed it off, but in 1997, the Prime Minister of Malaysia said to the IMF in a speech that there should be no FX trading. You should only be dealing in FX when there's real products being traded. He said it. And 1 year later, he cancelled all FX trading. We then had the Asian crisis. We should listen to these people and listen to the WEF, listen to the World Bank, listen to Biden, listen to Harris, listen to Johnson, listen to them all, because actually they're telling us what's going on, and we can actually use that in our investing.
Mm-hmm. So just to kind of clarify how you see this inflationary, let's say, path that we're on. Another quote that I pulled from one of your recent letters was that you said that there would be periods of disinflation or even deflation in an era of rising inflation. After 15 months of huge inflation, a pause is to be expected, and we are in it. So, are we going to get, peaks and valleys basically in this inflationary scenario that is playing out?
Well, nothing goes in a straight line. So that's why, in effect, what I'm saying is the trend is rising inflation. But of course, you're not going to go in one direction purely. So of course, there's going to be periods during the era of rising inflation, there's going to be periods of falling inflation, which is disinflation. There might even be periods of actual deflation, particularly if we do get, well, at some point, whether it's in a year or 5 years or 10 years, I don't know, at some point there will be a blow up in the stock market. That will be just like March of 2020, 2008, even a 20% fall in the market in 2018. These will be bouts of deflation. But as I say, the trend in inflation will be up. And then if you relate that now to markets, and perhaps you'll be able to put up a chart of the US 10-year Treasury for the last 20 years, you'll see that in the 2010s, you had the 10-year fixed between about 3%. This is off the top of my head. You'll see the numbers when you put it up. Bouncing between 3% and 1.5%. So that's why I'd said earlier that inflation did nothing. It was neither up nor down for several years. Then, of course, in 2020, we saw the TNX, the 10-year, pierce through the bottom. It went all the way down, I think, to 0.4%. And then quite rapidly, it came back up into that channel, that horizontal channel. And what I envisage is that the 10-year will be in a horizontal channel now for many, many years, bouncing between roughly 1.5% and slightly extended, perhaps 4%. Why 4%? Because historically, in rising inflation eras, when interest rates have got to 4%, until interest rates have got to 4%, you want to stay in stocks. And when they've got to 4%, that's when governments and central banks tend to take action. So I'm seeing 1.5% to 4% for many, many, many years. But of course, if I am right that inflation is rising for the next 10, 20, 30 years, and interest rates are capped at 4%, that actually, in reverse, is the reason why inflation is going to rise for 10, 20, 30 years, because they are going to cap interest rates, financial repression for the next 10 or 20 years. They cannot have interest rates much higher than 4%. The numbers are blindingly obvious. Everything would go bankrupt, including themselves.
That's what I was going to ask, Jonathan, is how can this, let's say, monetary path that we're on continue for 10, 20, 30 years? Isn't the risk of, a currency default or something like that higher the further we get out, and how long is that path sustainable for?
Okay. I don't know for how long. I have listened to dollar bears The dollar is going to collapse. Now, yes, of course, it's been on a multi-decade falling trend on the DX from 120, when was that, in the 1980s, down to 71 in 2008. Clearly, we're at 93 or so right now. And the dollar is going to go down to 60 and 50 and so on. Well, maybe so. What I envisage, however, and what I see is that the likes of China, the second largest economy on the planet, and the EU, the European Central Bank, these, which is also obviously a huge section of the global economy. Just to remind your listeners outside of the UK that the UK is no longer part of the EU. We have an independent banking system. Well, technically, of course, it's all related, but I'm saying similar, just as the ECB is separate from China, Britain is separate from the ECB. Okay. Mm-hmm. So Chinese debt is about the same level related to GDP as American, but it's rising much faster than American, even though the Fed has printed $4 trillion in a nanosecond. Similarly, the European Central Bank has printed even more as a percent of GDP than the United States. So the only possible competitors to the dollar in practical terms are the yuan or the euro. And there is no way on earth that they're going to take over from the dollar. Now, what I actually envisage, and this is possibly pie in the sky, but I think there's a case for this, is that the WEF, the party of Davos, as I call them, who are running the show, and the people who run the WEF, they have basically decided that there will be essentially two currencies, but actually it means there will only be one. Let me clarify. What I envisage is that because we have this rising inflation, that therefore means that every currency is debasing against hard assets. And I believe, although relatively short term, I am actually a dollar bear, relatively short term. I'm talking about weeks, months, but not long term. I see every other currency ultimately falling against the US dollar, but the dollar itself is debasing. Every currency is debasing. Even the Swiss franc is debasing. But by the time this scenario could play out, the dollar will actually be taken over by the central bank digital currency. And now the powers that be will pretend that we still have the pound sterling, the euro, the this, the that, and of course the US dollar and the Canadian dollar, but actually all of it will be around the CBDC, which will be the currency that they'll be using to control us all. That's how I see this all playing out. I'm terrified by it, but that's my answer to your question.
Mm-hmm. And you know, when I was preparing some of these questions, Jonathan, I was thinking about how basically the US dollar is measured against these other basket of currencies. So what do you think we should ideally be measuring these currencies against to actually give us some real perspective on how they are being debased, instead of measuring them, it's just which one is falling faster, but they're all relatively falling together, right?
Well, if that wasn't a leading question from a gold bull, I don't know what is. I'm actually not going to answer that question as directly as you might imagine. I will simply say the cost of stuff, the cost of eating, the cost of traveling, the cost of clothing, the cost of living, the cost of doing business. Anyone who does a weekly shop, anyone who runs a business, particularly in manufacturing, knows that the cost of just being is rising rapidly. I think to be very specific to say it should be in gold, or it should be in this, or it should be in that. Well, you see, that's taking market participation, frankly, to semantics and pedantics. I live in the real world. I invest in the real world, and I focus on charts. I focus on macro. I focus on history. And I'm just a guy in the business of trying to make money. I don't need to use I can't quite remember what the word is. Just esoteric ideas like that. Just the cost of stuff.
Mm-hmm. So, if we actually see a currency crisis, what happens to the banks, Jonathan? You've said before that they won't go bust, but you also don't advise anyone to hold their funds in cash. So what would you hold instead?
Yeah. Oh, the banks will not go bust. I know, as you know, that global central banks have produced rules and regulations for bail-ins. And the European island of Cyprus was the test case. Yeah, sure, we know all that. However, it's abundantly clear since 2020 that the central bankers, the politicians, the party of Davos, will just print ad infinitum, and they're not going to let those things that happened in 2008 to 2 or 3 major enterprises happen again. Of course, they may let it happen to someone who falls out of line philosophically and says the wrong things, but I really don't think there's going to be another banking crisis. Time will tell, obviously. I'll happily tell you, I'm a wealth advisor. I have retail clients. What does that mean? It means that my clients are technically and legally unsophisticated. Now, actually, some of them are sophisticated in these matters, but technically and legally. So they have the highest level of investor protection from the regulators in the UK. You will have similar in Canada and America. I've no doubt, of course you do. I will happily tell you what we're investing in. In effect, 95% of our clients, 95% of our clients' portfolio is invested in global energy stocks, the NDX, which is the Nasdaq 100, juniors, and uranium miners. Where do you want to start?
Well, we'll get to all of that. I have a couple things prepared for that, Jonathan. But before we do, I wanted to ask you, what are some of the narratives that you disagree with the most right now that are being presented, and why?
One, that we're about to enter a massive bear market. That we're about to have a massive crash. That we're about to have a global depression. You want to hold US treasuries or government bonds and cash. I find that infantile and stupid. with double-digit per annum broad money growth, it's ridiculous. With a low discount rate and yet a reasonable and growing economic growth rate, stock markets are still materially undervalued. There's not going to be an economic depression. There's absolutely nothing on the cards that could trigger that. We had the global depression for a matter of a number of weeks in March of last year. There is no way on earth they're going to have one within a couple of years. It's not possible. Sorry, it's not possible. It's there's not even a 1% probability. And because therefore of rising inflation, investors must get out of treasuries and government bonds. They must get out of cash if they're still there. Goodness knows why they are. And they need to get into assets which historically have done well during periods and eras of rising inflation. So that I disagree with that whole thesis. And goodness knows there's lots of bears out there, right, selling their newsletters and their subscription services. If your listeners are still paying that money, goodness knows why. They shouldn't immediately think to themselves, well, you need to have all opinions and all this in order to come to conclusion. What you need is the right opinion. Just look at the investment stats, look at the returns, look at actual achievements as opposed to clever, smart, intellectual thinking. I remember I unsubscribed to someone, no names, no fact drill, I would say, I don't know, 5 years ago. And I said to him openly, your writing is incredibly intellectually stimulating, but it makes me no money. So you get rid, clear out.
So is that the reason that you're investing in the NDX or the Nasdaq 100, as you said? And this kind of falls into your idea that you don't want to fight the Fed, right? Pretty well.
And also because all you have to do is look at the chart. I mean, if you were to show the last 2 or 3 years of the NDX, specifically the top 100 companies, it's a clear rising trend. As I say, it had a crash in early 20, and I have to compare it to 1987, which set off a dozen years of a mega bull market. Now, nobody is going to suggest for one moment that Amazon should have the market cap of the size of the UK economy. It's a nonsense. I don't care. It's rising. Well, Amazon itself may not be rising, but the NDX is. And indeed, incidentally, just literally in the last week, the NDX has broken above resistance that it's been held at about 15,000 for the last few weeks. I'm looking at the weekly chart here. It's just broken up. And it's interesting, your listeners will be interested to know that we are talking on the 26th of August on Thursday, just before Jackson Hole. And I would suggest that the NDX and wider markets are taking off because smart money, the insiders, they know that talk about taper and all this sort of nonsense isn't going to happen. The music's still playing, so they're playing musical chairs. And why not? And so am I. And as I say to my clients, we've got our money where the big money has got their money. So a sizable proportion of my clients' portfolio is in the NDX. And I don't care how big it is. I don't care what the price earnings are. All I see is the trend is up, higher highs, higher lows, and it's breaking up yet again. And at 15,000, I think we're good to 18 to 22,000 before there's a major correction. When I say major, I'm talking about 15 to 30%. Sure, we might see 5-10% corrections on the way, but yes, I think we're good for another 25 to 50% on the NDX within months.
Interesting. So, Jonathan, how does energy fit into your portfolio and thinking around investing right now?
Very nicely. Let me just look at my notes if I may. Right. So, one of the most deflationary countries on the planet, Germany, is now seeing the highest wholesale prices year on year, rising faster than since the 1970s. So when I see something as astonishing as that, and I don't believe it will particularly abate. Yes, it will slow down, but it will go on again. When I see statistics such as we saw recently, SNAP benefits for 42 million Americans rising more than 25% versus pre-2020 levels. And then they say there's no sustained inflation. I see the Baltic Dry Index. I'm looking at a chart going back to 2008. It's higher than since 2010. Look at the oil price. We're talking about energy. As far as I can tell from my reading of charts and markets, the astonishing thing that we saw in April of last year, that US crude WTI went to minus 30 odd dollars. I think I tweeted a couple of days later, when it went positive a day later, I tweeted, of course, I forecast it would go to minus $29 and then would soar. My newsletter is $1,000 a month. Sign up here. It was a joke, obviously. So from effectively zero, I believe, that's what I want to say, I believe that is a generational low. Quote, never unquote, to be seen again. Well, as long as I'm investing. And from such a negative sentiment levels, probably never seen in history, and sentiment is something that I watch fairly carefully. When it gets to extremes positive or extremes negative, I'm interested. From such negative levels, both in sentiment and in price, I think we're good for a decade of a rising oil price. We've already got up to $77. Yes, we've pulled back to the low 60s. Entirely normal. If we're in a multi-year bull, which I believe we are for oil, we could, according to the Fibonacci's, we could go back to the mid-50s and we'd still be in a bull market multi-year. I'm much more an investor than a trader. I don't quite know what these terms mean, each to his own and all the rest of it. I'm certainly not days, I'm not weeks. Perhaps I do multi-month positions, but not normally. Normally I'm looking at multi-years. So I put that into context for particularly, I think, the wealth advisors who are listening to your program. As well as the longer term traders, investors, individual investors. So I'm expecting $100 oil almost certainly by early 2023, perhaps by next year. I'm expecting within a few years for oil to take out the 2008 high at $147. And yet, Texan oil companies are making huge cash flows, positive, above $52, according to Eric Nuttall, one of your countrymen, a great guy, who runs an oil company fund. An amazing statistic to know. So above 52, and we're well above 52. And we're going to be well above 52, 55, 60, 70, 80, 100 for years. Global energy companies have been hated, because they've been not making any money for a long time. And of course, now you've got the idiot politicians and their green nonsense, which is the second biggest fraud in history. So when you've got such negative sentiment, and yet you've got demand for oil and gas rising every year, while supply isn't, well, it's economics 101, it's markets 101. It's, to my mind, it's simple. Keep it simple, stupid. And that's what I try to do. So yes, a big chunk of our clients' portfolio is in global energy, which means much more upstream than downstream, although downstream will make money too. But I think there's huge amounts of money is being made in production. And as the markets see the oil price rise, and by simple dint of that, we have seen, but not hugely, we've seen oil and gas company prices rise, but not hugely. As they rise more and more, eventually the clients of the pension funds, of the trustees, the sovereign wealth funds, they'll say to the ESG merchants, hey, we actually need to make some money. So that's when, so the smart money is already there. The next professional money will come in, then you'll get the retail money. I think we're good for 5 to 10 years of huge returns, multi-100% returns in global energy.
So how does the green energy initiative that you mentioned there, how does that initiative work in your mind? Are there good examples in Europe that show us some lessons that we need to learn right now?
Well, it's not just Europe, it's globally. So, you get the party of Davos, Fink at BlackRock is very much a leading light there. The guy runs, $9 trillion? I mean, his power is remarkable. Vanguard too, and all these other big guys, the amount of power they have because they've got assets in goodness knows how many pies. So they're leading. Apparently, climate change has come about because of humans, not because of the thing 98 million miles away, which is 300,000 times the size of the Earth. History tells us that's the thing that determines climate change. So the politicians see it as a vote winner, and clearly it has been. It's taken on by all the politicians in the so-called democratic world, and they're just not investing in oil and gas and the like. So they are investing in Elon Musk, electric vehicles, the big car manufacturers. I mean, one of the German manufacturer alone, I can't remember which one, but I remember talking about it. One of them alone is going to be putting $150 billion into electrification. Just one car manufacturer. I mean, it's remarkable. So we're seeing, Germany, I mentioned earlier, has got the highest energy costs in Europe, and it's also got the most money invested in the green stuff. It's because of taxation. They've got to tax. And so what are they doing? They're importing vast amounts of gas from Russia, who couldn't give a damn about the green nonsense. Russia, China, India, who are building a coal plant a week, they're laughing their socks off at the West, who are killing ourselves economically. I and my clients, we're laughing our socks off at everyone not investing in energy companies. That's all ultimately I'm interested in.
So, Jonathan, I'd like to turn a little bit to gold. You said that gold reacts really well in a stagflationary environment. So why is that?
Because you have bigger and bigger negative real rates. And as I said earlier, the financial repression is that the central banks will keep long rates down, basically for quote ever, while inflation rises for quote ever. Thus, negative real rates get bigger and bigger. And it's a very simple thesis. And although, of course, for the last literally 12 and a half months, we've seen gold down to flat, silver similarly, miners down rather than flat. It's irrelevant. It's the big guys clearing out the weak hands, the people who I think of day and week and month traders who are watching squiggles and who are being booted out at the wrong times, and they're fearful for coming back in. Very similar to what we call the baby bull in the first 7-8 months of 2016. Everyone was so massively demoralized by the end of 2015. Practically no one was in. I had a small, I think 5% in the client's portfolio holding of juniors. That trebled in 7 months. And it's all about demoralization. And you know what, actually, Tom, although it's irritating, it's infuriating, and it costs money, the length that this correction has taken is actually a good thing in market thinking. The bigger the base, the bigger the space. Did I expect it to be 12? Well, actually, it hasn't really been a 12-month, because look at the chart for gold itself. I think I sent you such a chart. If not, I'm going to look it up myself. No, okay, I'm going to pull it up and look at while I'm talking to you. So, if you look at the mini crash in gold in March of 2020, and it's interesting how people talk about the crash in all assets in that month, or in that roughly 3 or 4 week period. Gold, of course, quote only unquote, went down 15%. Gold largely held its own, which was very, very interesting. But you look at that, you see resistance prior to the mini crash at 1700. We then had the mini crash, it went back up to 1700, and we then had support after breaking through 1700 at about 1700 for the next couple of months. We then had the rally, which lasted a couple of months. Everyone knows it went to 2100. Interestingly, I said to my clients that the March 21 low of about 1700, okay, 1675, which was pretty well immediately retested. I've been saying to my clients for the last few months that that is likely to be the low, and I'm not sure we'll ever see it again in relative terms. Interestingly, of course, we saw it on the 9th of August. A retest of clearly a hugely important support level. So that's what my point. Although it feels as if it's gone on for 12 and a half months, I think actually it was August to March in gold. So on that basis, we had a successful retest, 2 weeks ago. Intraday, 1675, closed 1725. It was up $50 within hours. And where are we now? Approximately 1800. So 1800 is the new important level on a smaller scale. 1675, 1700 is a huge level. 1800 is the next level. We clear this, we clear 1840, and I believe that we will. Then the next level, going back to my chart, is 1960, which we saw it bunching around 1960 in August or September of last year, again in November, again in December. So 1960 is the next major level, but this is important. I actually believe that March was the low, August was the retest, successful, and while currently as we speak, 5 o'clock British summer time on the 26th, we're not at 1800. I think we will be. It could be today or tomorrow or Monday. Well, okay, or Tuesday. My point is above 1800, and I believe that we are actually still on the way. Below 1800, then there is a minor risk that we could yet again retest 1675. And people should know that below 1650, and I always like to leave a little bit of a buffer on my technical analysis if it breaks a huge support. Below 1650 on a close, and particularly on a weekly close, it's going to go back to 1450, which was a low in 2020. But above 1800, and we're more or less there right now, I think we're on the way to all-time highs this year.
So, Jonathan, you also sent me a chart that was talking about the sentiment in gold right now. So how has gold reacted to sentiment in the past being as low as it is currently?
And I've got that chart somewhere. No doubt I'll not find it. But the answer to your question is that whenever sentiment is incredibly negative, just like I was saying in oil previously, that has been the trigger for setting the market off. What I actually have is a sentiment in juniors. 2018 sentiment, the sentiment, or indeed another way of looking at it is the number of members of the juniors index above their 200-day moving average got down to about 10% only. Mm-hmm. And it did it again in March of 2020. And 2018 was, of course, arguably the confirmation start of the multi-year, multi-decade bull market. Now, you could say it was 2016, but actually it went back down into 2018. So 2018 was, and then 2020, of course, we had the crash in miners, as we did in stocks generally, and the number of issues above 200-day was tiny. What happened after that? We saw juniors go up 200% in months. And interestingly, that's exactly where we are right now. the number of members of the juniors index is at 11% above the 200-day moving average. This is a huge buying opportunity, which, as far as I'm concerned, juniors are likely to double within a few months, while gold itself goes from about 1,800 to somewhere between 2,200 and 2,600 within months. Very similar to end March to beginning August last year.
So one of the other asset classes that you mentioned there, Jonathan, was uranium miners. So why is the news of Sprott entering the uranium market such a game changer to you? Yeah,
well, first of all, for the first time in history, we'll have a daily price on uranium that we can effectively trust. That in itself is going to entice institutions to get involved, hedge funds to trade. I'll never forget some years ago. I can't remember exactly what period, but I remember George Soros being quoted as saying, gold. Yes, actually, I remember now. It was in 2010. Gold is in a bull market. Sorry, gold is in a bubble, so that's why I'm buying it. So my point being, the hedge funds got into it because they could daily trade it. They could get in and they could get out, which of course is what we have with the SLV, the GLD, and indeed the Sprott equivalents. So now we've got something similar for spot uranium. Absolutely fantastic. So one, you're now going to have a far, far, far bigger amount of money that potentially could come into this market. And secondly, it's more demand to buy uranium than there was. And it's remarkable. Within weeks, they've bought, as far as I know, £1.5 million. This is in itself a sizable mine annual production. And if he's doing that in weeks, and as from what I can tell, this is not going to slow down. I think we've already seen uranium spot was in the doldrums at $27-30 for some months. We're already now at 33, I beg your pardon. It's jumped to 33. I think it's going to go rapidly to the high 40s. It's going to take out the high that we saw months ago of 35, 36. When you then look at uranium miners, and we've seen them similar to gold miners being a multi-month correction, actually uranium miners has not at all, not even closely being as long. Uranium miners, according to the fund that I look at, peaked in June, and I believe that they troughed just 1 month later. I'm happy to say, the Geiger Counter Limited fund, which is in the LSE, is interestingly the only fund of miners in the entire European continent. Mm-hmm. And it's amazing. It's tiny. It's like 40, 50, 60 million pounds. It's under $100 million US. It's amazing. It's absolutely tiny. It shows you again how hated this market is. Sentiment, yet again. This fund, when it peaks in a few years' time, will not be, say, £50 million. It'll be something between 250 and 500 million pounds. And that's without new entrants. With new entrants, it could be £1 billion in a few years' time. The opportunity to make money is absolutely breathtaking within a relatively short space of time. So how do you think about actually playing that, Jonathan? Are you buying
individual uranium equities? Are you buying these funds? How do you think about going about that?
Yeah, well, I personally have holdings both in Geiger Counter, which is GCL, if anyone's interested. I have nothing to do with ownership or management of the fund. I just invest in it. I also have individual issues. It's a global fund. It has Kazatomprom. It has Cameco. It has some 30 other global companies. In other words, practically every company there is. There's only about 30 or 40 of them. Mm-hmm. So if you're not an expert in this area, just get into URNM, or if you're on my side of the pond, just get into GCL. If you want to accept materially higher volatility, and as I say to my clients and anyone who will listen, volatility does not mean downside. It means movement up and down. If you want to accept even greater volatility, then yes, just invest in any of the well-known names and just hodl, as the crypto guys say, for the next 2, 3, 4 years. And the sort of thing you should be looking for, go with, what's his name? Is it Kevin Bambara? Is that his name? He used to work for Sprott, one of the senior guys. Mm-hmm. You'll see him on Twitter. Extremely clued in guy. As he says, the 2007 peak in uranium was 135 US. Well, first of all, we're say 15 years of inflation further on. So just simply on an inflation basis, we can see uranium get to say 175. But forget that. The demand is materially higher. The supply is nowhere. I will be surprised if we peak out at less than $200. And as Bambara says, it could go to the stars. It could go to $400. I don't know. I don't really care. I just know that GCL is a very well-run fund. In the crash last year to March, it went down to 9. We had a significant holding. We doubled at 17 on a private placement, because if we wanted to double ourselves, we'd have annihilated the share price, because they couldn't have handled it. It's such a small fund. A year and a half ago, if we wanted to double, it was only something at, I don't know, 20 or 25 million pound fund. It's remarkable. So we had to get a private placement. It's been up to 45. It's now, it's been down to 32. It's now 37. And as far as I'm concerned, I'll be amazed if we sell it only 150. I'm expecting more likely it to be 200 to 250. And that's comparing it to how well Cameco got to in 2007. This fund was started in 2009, so we don't have the 2007 history. I think it's a reasonable guesstimation. So, from roughly 40 now to 200, that's 400% in a few years. Thank you very much. I'm expecting that to happen.
Excellent, John. We covered a lot of stuff in this discussion here. Is there anything else you'd like to touch on before we wrap up?
Thank you for asking, which I know is one of your modus operandus, and a very good idea to do so. I will mention one thing. I mentioned about Mahathir Mohamad, the Prime Minister of Malaysia, who told us that there shouldn't be FX trading, and then a year later gave plenty of warning. He outlawed FX trading. And when Powell and this crowd, when they say things, pretty well believe them. The number of people on Twitter say, "Oh, I don't believe that liar." Well, it literally would be criminal and prosecutable if they lied. So we should believe these guys, and we should watch what the big money does. Too many folk, particularly retail investors, follow smart, intellectual, intelligent guys on Twitter without actually following the money movements, in other words. So find guys who are smart at following money movements and listen to what they have to say. So similarly to Mahathir Mohamad, Xi Jinping, the president for life of China, is telling us that he's increasingly, shall we say, displeased with anything outside of China, outside investors, particularly the US. And the US, of course, is displeased with China. We know this. Don't fight it. It will not surprise me if in the next year or 5 or 10, Xi Jinping, assuming he's still in charge, what I mean is he's alive, because the only way they're getting rid of him if he dies, it will not surprise me. And in fact, I largely expect him to put in place absolute capital controls. Your listeners who've got money or assets, indeed, in China, get them out as soon as you can. Because as far as I'm concerned, the only opportunities now out in China are trading opportunities. They are not investment opportunities, irrespective of economic growth and all that kind of stuff. With China taking over politically and authoritatively, if that's the right word, Hong Kong, taking away democracy, it will not surprise me that China takes on the assets of Hong Kong, of which Westerners have $500 billion of US, and outside investors will not be able to get that money out. Well, you can, but it will be in yuan, which you can't spend anywhere. And with all the political realpolitik going on, the yuan will devalue because global investors will take assets out from anything Chinese related. Get money out of China, because from now on, you are picking up pennies in front of a steamroller.
Interesting. That's a good perspective to give anybody that has any assets over there. Jonathan, of course, you're available at jonathandaviswm.com as in wealth management, and at Jonathan Davis on Twitter. We'll put the links. It's J0, right?
Yeah, where the O is a zero. That's right. Yeah.
Right. We'll have those links in the show notes. Jonathan, thanks so much for your time today.
My great pleasure. All the very best. Keep up the good work.
Thank you. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.